Welcome back. So it's been a dozen years this month since the mortgage crisis began. Now there's a lot of talk about recession and that we are due for another pullback. My guest is Greg DuPont. He's an advisor and an attorney in Dublin, Ohio. Greg, thanks for talking with us. What is your take? Where are we right now?
Scott, we are in really uncharted territory right now. We are at a spot where the underpinnings of the market are really stressed, and the market itself is at a high, and the bond market is at a low. So we kind of are in a spot where the government has fired all of its shots and have tried to extend this bull market almost a historical length at this point in time, and the investor really needs to be cautious right now.
So stocks are expensive, bonds are expensive, real estate is expensive as well. This is kind of an everything bubble. What are you telling your clients right now?
I tell them that nobody's got a crystal ball, right? I can't tell you when the next crash is going to happen, but I can tell you every time the market started thinking that it wasn't going to happen again, guess what? It happened again. And if you are on the eve of retirement, then we need to be watching your portfolio with a very cautious eye. Understand the typical investor, I don't think they realize that when that slide happened back in the 2007 era when it started, it took from October 2007 down to March 2009 before the market bottomed out. And there are lots of opportunities along that path downward to have gotten out and protected against some of the loss instead of waiting until sometime in March of 2013 where we finally recovered that value that lost from October of 2007.
And then what about the investor who's taking income? They need to be cautious right now, don't they?
Oh, absolutely. There is just a tremendous exacerbating effect of pulling income out of your portfolio in a down market. Those trends that help you accumulate when you're putting money in when the market is down work against you in retirement when you're pulling out your money from your portfolio. So if you are in a position where you need to generate income from your portfolio at this point, you need to be looking at whether or not to offload some of that risk to an insurance company through the form of an income annuity if you really do need that income. If you don't need the income right now, then you need to hold off potentially, or at least segregate those funds so that loss does not get exacerbated if the market goes down.
Now, to clarify, what you're talking about is not giving up growth, just transferring the risk.
That's correct. The insurance companies that are behind these annuities that are used for income, they're the ones that bear the risk if you use that tool instead of you bearing the risk. And so if you do need your portfolio to generate income in a choppy market like we are looking at, or a downright bear market that is potentially on the horizon, you need to be leveraging that tool and have them bear the risk instead of you.
That's Greg DuPont in Dublin, Ohio. This is Retirement News Online. Thanks for watching.